Hi there and welcome to the Open here on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we are following in the BNN Bloomberg newsroom. Canada's annual inflation rate held steady last month. Data from StatsCan shows the consumer price index rose 2.2% from a year earlier, matching the rate in October. StatsCan says lower prices for travel, tours, and accommodation, as well as slower growth in rent prices, put downward pressure on headline inflation. Meanwhile, grocery price inflation rose to the highest since the end of 2023. Home sales across the country saw a decline last month along with home prices. Data from the Canadian Real Estate Association indicates national sales fell 10.7% in November compared to the year before. Home prices, meanwhile, fell 0.4% month over month. The association says housing activity has turned into a holding pattern heading into the next year, adding that continued trade tensions with the U.S. have weighed on buyers' confidence. New listings also saw a decline in November. And shares of Canopy Growth are seeing a rise in pre-market trading. The Canadian cannabis company is acquiring Quebec-based MTL Cannabis. The transaction is valued at $125 million. It represents a premium of about 45% to MTL's 20-day average price. Canopy says the deal is aimed at strengthening its medical cannabis business and boosting capacity to serve growing international demand. And taking a look at the markets, looks like they are recovering from that drop on Friday. You can see, on the positive side right now in the futures, the Dow up by a half point, NASDAQ 100 by 0.7, S&P 500 up by about 0.56 right now. The TSX, after hitting an intraday high on Friday, ended up down about 0.4%. We'll see what it does this week. A lot of economic data ahead, and that's what people will be looking for. Moving over to oil, continues to struggle a little bit. It's down 57 WTI, still off for the year by nearly 20%. Taking a look at gold. You can see it is continuing to trade up near record territory. It's up again, 0.95% and up 63% for the year. And the dollar, it is trading up ever so slightly right now as we head into the last couple of weeks of the year. And finally, Bitcoin. It is up again. It's been struggling. It was down here about 86,000, but it's back up, getting close to 90,000 again. A little bit of a surge over the last few days. Stats Canada just released the latest inflation numbers, and let's get more now from Garnett Anderson, Head of Portfolio Management at Tacita Capital. Garnett, thanks very much for joining us today.
Thank you for having me.
I guess down a little bit down, especially in the core.
Well, a little bit of the core,
just not a huge amount, but
not a huge amount, but a little bit of a positive because that's been relatively sticky on accommodation, on because you take a look at the core. You're taking out really the food, which has been quite volatile, and energy, which has been all over the place. Mm-hmm. And when you take a look what the Bank of Canada tends to focus on is on those core, the trims and the medians and so on and so forth. And they've been sticking up at that 2.8, 2.9%, nowhere near where we were back in 2022 and early 2023, but still not down to that 2% range that we're really more comfortable with. So that stickiness, and you even see that some of the stickiness come through on the wage growth front, right? And it's been particularly in the services area as opposed to the goods area. There was a little flip this particular month. So ideally, you'd like to see that come in a little bit more. Because right now, if you're sitting there as a bond investor, you're kind of going, okay, well, I'm getting yield, I'm getting some downside protection, which we can chat about. But really, it's my inflation target. What's my real return going to be? And you take a look at the general consensus of the economists, it's 2% for next year, 2.1% for 2027. And now that is mainline CPI as opposed to core, and mainline CPI is in that 2.2% area as we saw today. So because core can feed a little bit over into total CPI, just want to see that core come in a little bit more. And we certainly see from the States where that's revving a little bit high as well. And so when you take a look at the futures rate today, the information that came out, it hardly moved the probabilities around a Bank of Canada cut in the January meeting. And in fact, all in Q1.
It doesn't look like anything for. I mean, you were talking about a raise at one point, right?
Well, yes. If you look at the forwards, it's actually over the course of 2026 that probably suggests there's more of a probability of a hike as opposed to a cut.
Yeah.
So that's where, again, you've got a little bit of stubbornness, and we did get that positive GDP read for Q3. I mean, there's folks that poke holes out in, and probably legitimately, but that was a little bit of a positive surprise. Some decent numbers, all things considered, on the employment compared to where we were talking back in the spring and thinking what the world, was going to fall down.
April was an unusual month, shall we say, especially in this. But it seems like the country has kind of bounced back to a degree.
Resilience, and I mean, again, when you think about the role of inflation, it permeates. We saw in 2022, if you get a spike in inflation, it cuts the knees out from every asset class, except for maybe gold and maybe cash. We saw bonds get hammered, we saw stocks get hammered, real estate get hammered, infrastructure get hammered. So really, and that's more of a pervasive effect. So if they can kind of keep a lid on that inflation, then that helps support all those areas. And in particular, it makes bonds a little bit more palatable. And why talking about bonds? They're not particularly exciting most of the time. But again, decent real return.
Sometimes solid doesn't have to be exciting.
Well, exactly, because people are running around saying, well, are we in an AI bubble? And certainly in Canada, when you take a look at our market, Canadian market did fantastic. So far in 2020, realize it's glass, not wood, but so far in 2025, but that was really, a lot of that's pumped up by gold. So again, it's a commodity trade. No, it's not iron, it's a different kind of commodity. So if people are worried about some of the valuation levels and some of the growth rates and some of what USMCA renegotiations could occur in 2026, just a little, reminder, maybe take a look at the bond side, maybe do some rebalancing. The real return there is not bad. Again, as the real return as measured with historical.
What are we seeing for real returns then?
Well, right now, if you take a look and you say, okay, well, the 2 years at 2.6, the 5 years around 3, the 10 years, this is Canadian government, and around 3.5. If you went provincials, you can, without hardly any extra credit risk, you can pump that up by 0.2%, give or take. Then if you take off your 2.2%, now that's historical inflation. Bond investors only care about front windshield stuff. And again, if the economists come out and they're correct, and that's around 2%, those are decent real returns compared to kind of the 25-year average there. So the bond, this isn't like going back before COVID when interest rates were like less than 1%, negative halfway around the world, and you're just looking there going, I don't understand why I'm owning bonds. We're going to go really light on bonds. So bonds have a place in the portfolio, particularly those worried about valuation levels on the AI trade stateside. And then you've got the decision, well, what kind of bonds? And if you take a look at the main benchmark, so a lot comes down to credit. Okay, most people buy in a basket, so credit isn't a massive concern. Where it permeates is when we had the COVID March, and corporate bonds just got eviscerated for all about 3 seconds, and then they came back. But you saw that period where corporate bonds did get hurt. As long as you held on, you were fine. So do you go long duration, higher interest rate sensitivity, thinking that we're going to go into recession and you get the bigger pickup there? Probabilities of recession now in Canada, 30-35%. That's not a super high probability. So that's probably not the trade. So we're a little bit shorter duration than the benchmark, and the benchmark's up at 7, a duration of about 7. We're lighter, we're more around 5 duration, just in case inflation peaks its head up a little bit more. And we're not giving much in the way of yield to get there, and it gives flexibility that if there's a stock market setback, we have some capital, step in,
jump back in. And where is that all Canadian, or are you looking to?
We do. We have. I mean, we run through the spectrum. We run through a spectrum of investment grade Canada, and the reason Canadian bonds are important for Canadian investors is really collective risk. Is you have to over the years keep pace with Canadian inflation. So Canadian bonds are decent over time to do that. And again, when you take a look at the returns and while you can hedge away currency risk, if you've got a bunch of foreign bonds that are unhedged, sheer shifts in FX can just swamp any fixed income return you thought you were going to get. So we do have some global fixed income in there as well. We have some high yield, and we have some preferred shares. So again, blending that out.
And we almost out of time, but I wanted to get to. I didn't realize this went quickly because we were talking about the bonds. But a couple of companies you want to talk about. Boralex. Well,
Boralex is, I've had a chance to chat with you before, and often it's around a stock that's at its peak. It's at its 52-week high, and we're going, great company, but just is it the time to go in?
Yeah.
Boralex is a little bit different. It has been beaten up. Its drawdown right now is in the 50% level. It's well off. It's off about it is 12% year to date.
Yeah.
Its valuations are relatively cheap. Now, you don't get cheap without a reason. It's disappointed on the earnings front from its wind farm oriented. So they've had substandard conditions there. It's got hydro. It's had substandard conditions there. They do have a growth platform. It's not going to be a turnaround story in all one fell swoop. They do have a growth objective. And analysts are very pro on it. Like you take a look at the price to the 12-month target, it's like 45% upside. Don't think we're going to get the 45%. It'd be nice if we did. I don't think we will. But it might be a stock that if people say, okay, I'm going to start to edge in now, 2, 3, 4 years out, they can walk out their plan, minimize the number of negative surprises. Might look back and could go, not a bad entry point.
Okay. We're going to have to leave it there, but Garnet, thank you as always for joining us.
Thank you.
That was Garnet Anderson, Head of Portfolio Management at Tessida Capital. Coming up, we'll do a broader check of the markets and look at some of the early stock movers, including iRobot, pre-market. Look at this. It's plunging right now, of course, close to declaring or in the process of declaring bankruptcy and being taken over by one of its suppliers in China. More on that coming up. Here's how things are shaping up on the markets. We'll start with the U.S. futures, and they are climbing amid some bullish calls for 2026. Of course, we're also awaiting jobs data this week in the U.S., but you can see right now that everybody is in the green. NASDAQ looking to bounce back from that rough day, especially rough day on Friday. Heading over to Europe now, and let's see how they're doing in Europe. There we go. Patience is a virtue. In the green there, all of them hovering around near record territories. FTSE 100 up by nearly a percentage point. The CAC 40 up by more than a point. And the German DAX up by 0.37 this morning. And taking a look at the TSX. Intraday, it did hit a record high on Friday, but then closed the day off by 0.42%. See what it does today. Again, everybody's kind of waiting for that economic data. We'll see what the inflation numbers, the impact that had as well when the markets open shortly. Heading over to metals, and you can see gold, silver, copper, all up, all hovering near record territory. Silver's actually in record territory. Gold's close to it at 4,361. Silver's $64 almost, and you can see copper's even up nearly 2% at 546. And look at iRobot. It is off. Not surprising. It's down 72% after the company filed for bankruptcy and proposed handing over control to its main Chinese supplier. Taking a look at a couple of movers in the pre-market going the wrong way, though. Adobe down by 1.3%. ServiceNow off by 5.3%. They were downgraded to underweight at KeyBank, which sees AI tools bringing a bigger hit to both software firms than anticipated. Well, after the break, we'll do a deeper dive into today's inflation data and implications for the Bank of Canada next year with Dominique Lapointe, Director of Macro Strategy with Manulife Investment Management. Canada's latest inflation data rose 2.2% on a year-over-year basis in November, matching the increase seen in October. Let's get more now from Dominique Lapointe, the Director of Macro Strategy with Manulife Investment Management. Dominique, thank you very much for joining us.
Good morning.
Your thoughts on the overall number first?
Yes, I think it's an okay print, Roger. 2.2%, just above target. It's the second consecutive months we are there. And it has a recap for 2025. We were for most of the time just below 2%, and now we're just a little bit above it. So the good news, important news, is that it's not running away from the target. So yes, overall, I think it's an okay print, and it's a sign of reprieve for people who would be concerned about inflationary pressures.
And any concerning numbers within it? I'm looking. Food month over month was up 0.2. Food was 0.9. CPI 0.2 month to month. Shelter was helping drop that down, but that's because the markets are kind of crashing. Any numbers concerning to you?
So food prices are always concerning. You've mentioned they were up 0.9%. It's actually like 5% year over year, and you have in there like beef prices around 30%. So it's always very concerning for that. However, that is not something that the government or even the Bank of Canada can control easily. StatsCan's mentioned, again, problems with climate change, with droughts, lower inventories. And at the same time, interestingly, this morning, StatsCan mentioned that U.S. tariffs on coffee are putting upward pressures on international prices for coffee, and that has indirect impact on Canada. So that's concerning, but that's not something we can control. And then, like you mentioned, we have other dynamics that are, I'd say, ingrained into the Canadian economy that continues. You have shelter prices continuing to see like lower inflation, and that's because mortgages are being renewed at a lower rates than last year. Home prices at the national levels are somewhat lower, so that's putting downward pressure on inflation too. And similarly, gasoline prices are still lower than a year ago. So all these items are somewhat pushing down inflation, and that's offset by some upward pressure on food prices, but also on other items like cellular phones that are somewhat more expensive than a year ago. So again, overall, I think it's an okay print, and that testifies that there isn't a lot of broad-based inflationary pressure.
And so what does this point to for the Bank of Canada moving forward now?
I think a big question coming into this report was if we were going to get a print that was somewhat too hot that would show that inflationary pressures are making a comeback. We've had some of those scares earlier in the year, which put into question if the Bank of Canada would be able to cut at all to support the economy. Then it turned out okay, and the Bank of Canada was able to focus on lower growth, on then what was the rising unemployment rate. And so the question this morning was, are we going to get somewhat of a hot print that would say we've cut too much, the economy is doing fine, we've saw the labor market rebounding, and so maybe we're going to need to hike next year. And I think with that print, it really relieves the pressure for the Bank of Canada to do any move at all. And we thought before the last decision that they were going to be on hold. We continue to think that for 2026, overall, they're going to be on hold. The focus will be on lower domestic growth, slower consumption, tariff uncertainty, making a comeback next year. And that's why inflation is not going to be the main concern, at least for the next couple of months.
And there was talk at one point that it would be either static for the Bank of Canada rate, or they might actually do an increase, possibly do an increase towards the end of the year in 2026. Does that look like that could still happen at all?
We can't exclude it completely, and many things can happen next year. However, if you look at what happened in terms of expecting that rate hike, it really came after the November labor force survey, which showed the unemployment rate in Canada dropping from 6.9% to 6.5%. And when we looked at the details, we found it's one of the only time in recent history when you had a shrinking labor force at the same time as you're creating jobs. Usually these two things go hand in hand. You're creating more jobs, you're bringing people back in the labor force. So it seems to us that those kinds of statistical, I'd say, anomalies are unlikely to be repeated, and that what we're really left with is an economy where we don't have many widespread layoff, but at the same time, we're not creating a lot of jobs, and certainly not next year. So therefore, I think it's very premature for the market to anticipate a rate hike. And the Bank of Canada, their message last week was that they're not thinking about rate hikes right now. And we would really need to see bigger surprises on the consumption front, on the business investment front, so that they would think that they have to hike next year.
Okay, I just want to get a couple more questions before we go. Just going back for a second, we saw gasoline was down quite a bit. Any concerns that's going to bounce back, or what's driving that?
So, like you mentioned, gasoline inflation is down versus a year ago. And what we saw this year, to explain that, is there isn't a lot of global pickup in demand for oil. With the tariff uncertainty, with, I'd say, below average growth in the EU and in Japan, pretty much everywhere, there's a little bit of an imbalance between supply and demand, where we're adding a little bit of supply to oil, so that doesn't put upward pressure on oil, and therefore gas prices this year have been somewhat weak, which is a good news for the consumers. And for next year, our team doesn't expect also that gas prices are going to go up. Obviously, there's upside risk to that if we have geopolitical events unfolding, but the market doesn't seem to suggest we're going to get higher gas prices next year.
Okay, we've got about 40 seconds and we have to get out. But just quickly with tariffs, you mentioned it. How much of an impact do you see it being for next year?
In Canada, very little. We've removed most of the tariff on U.S. goods. There's still a little bit on that on cars. But now what we're seeing is that it's at the global level, where U.S. tariffs seem to have an indirect impact on global goods and therefore inflation in Canada. But I'd say it's very limited.
Okay, we'll wrap it there. Dominique, thanks as always for joining us.
Okay, thank you, Roger.
Dominique Lapointe is Director Macro Strategy at the Manulife Investment Management. Well, the opening bells are coming up next. Stick around. We'll see how the markets are going to do today after a rough Friday. That's next. All right, here are the opening bells at the NASDAQ. We can see Tractor Supply Company, TSC, shows up in so many smaller towns around the country and in the States as well. They are ringing the bell at the NASDAQ. At the New York Stock Exchange, Barron Capital ringing the opening bell. And at the TSX, Erdene Resource Development opens the markets. It is a Canada-based resource company. Looks on the acquisition, exploration, and development of gold, copper, and magnesium and other metals worldwide. There you go. This is BNN Bloomberg, and trading is just getting underway. Let's check in on the equity market and see how things are doing. You can see that bounce back from Friday when everybody was off. Looks like it's off to the races for today. And the TSX getting in, closing in on that intraday record high they had on Friday. It's still off by 100 points, but it's up. And right now you can see it's up a half a percentage point. The S&P 500. Similar situation, up by 0.45%, and the NASDAQ after that off day on Friday as well, bouncing back right now, up 0.56%. And shares of Canopy Growth are seeing a rise in early trading. The Canadian cannabis company will acquire Quebec-based MTL Cannabis. The transaction is valued at $125 million. And represents a premium of around 45% to MTL's 20-day average price. Canopy says the deal is aimed at strengthening its medical cannabis business and boosting capacity to serve growing international demand. Now, it was trading up on the pre-markets, but now it's off by 0.42% as we look. And for movers south of the border, we're joined now by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities Team Stocks. And thank you, as always, Jeff, for joining us. Appreciate it.
Yeah, my pleasure. Happy to be here.
Okay, let's, for a Monday morning, ServiceNow is working on a big deal.
ServiceNow is working on a big deal. Bloomberg reporting this morning that they are in advanced talks to buy a private startup company called Armis. They are in the cybersecurity business. This is a deal that would be worth potentially $7 billion. So a pretty sizable deal for them. And as a result, shares are coming under a little bit of pressure. ServiceNow is the worst performing stock on the S&P 500. It was down 5.6% in the pre-market session, and definitely one to watch today, whether or not we get some confirmation one way or the other on whether this deal is getting close. For some context, Armis is a company that just earlier this year said that they had reached $300 million in annual recurring revenue, and they had expected to go public at some point in 2026. So if this is a takeout by ServiceNow, that's potentially one IPO for 2026 that may not happen.
Well, we started to talk about we hadn't seen many IPOs. Now we may not see another one not coming through. TI dropping. Goldman double downgrade. That's easy for me to say on a Monday morning. Double downgrades to a sell. It's too early.
Double
on a Monday.
downgrade. Yeah, the dreaded double downgrade.
Double secret probation.
Goldman has taken That's right. Yeah. Goldman has taken Texas Instruments down from a buy rating to a sell rating. So we're skipping neutral. We're going all the way to sell here for Texas Instruments, and it cutting the price target to, to $156 from $200 per share. That's not all the way to a street low, but it's pretty close to it. So the stock is falling. This was the second worst performing stock in the S&P 500, and definitely worth watching over the course of the day. Two things that Goldman is flagging here. One is the cash flow per share metric. They expect to see a little bit of pressure on that over the coming year. And the other thing that they flagged, and kind of a brutal comment from Goldman, that the capital choices and some of the strategic choices Texas Instruments had made over the course of this year is going to be a drag on the company. So it's a nice way of saying poor decision making, and that's why they get the dreaded double downgrade this morning. Buy all the way to sell.
And such an iconic company too. Everybody had their
right. Yes.
for old people.
Yeah,
everybody had their computer or their calculators, right? When we were younger.
That's right. Exactly. Yeah, they do a lot more than just the calculators. But that was my interaction with the company. Absolutely.
All right. I think that wraps it up, Jeff. Thanks for joining us as always. We appreciate it.
My pleasure. Thank you.
Coming up after the break, we'll do a quick check on what's trending in the markets. Recent quarters have shown a strong growth as higher metal prices and volume from new and expanding streams lifted gold's production roughly 22% year over year. For more on this, we're joined by Shiraz Ahmad, CEO of Sartorial Wealth. Shiraz, thank you very much for joining us today.
Great to be here.
All right, let's get in. I guess, do you want to get right into the stocks?
Sure,
or anything else catching your eye right now?
Not necessarily. I'm happy to chat more about the stocks.
Okay, well, let's do it then. First up, Wheaton Precious Metals.
Yes, it's a name that we like. We've owned it off and on for several years. It's part of our Sartorial Opportunities model, which is really a quantitative-driven momentum model. Mm-hmm. And at the moment, we're seeing strong positive momentum in the metal space, other than a little bit of a hiccup earlier in October. But other than that, it's been a strong performer, lots of free cash. And we like it as a way to be able to play both gold and silver.
And what are some of the things you're looking at that give it that momentum that you're liking?
Well, right now, the major variable is obviously price momentum, but obviously volatility as well. We want to see, is it worth the risk that we're actually seeing in the actual security itself? So over the last little bit, it's been positive. So it's been a position that we've been participating in.
And the price, I guess, is tied into gold, obviously, and the metals. And any concerns where it's going right now?
Well, we try to not make too much of a macro prediction on where we think the metals are going to go. Right now, the momentum is positive. I do think that, if you look at what's been happening over the metal in the last year, specifically gold, silver is kind of a quasi-industrial metal, but gold specifically is really the ultimate vote of no confidence in sort of administrations around the world. So right now, you're seeing that investors are thinking that gold is a safe haven asset. We want to park money there. And our way of participating in that is with with Wheaton Precious Metals and a few other securities.
Okay, and Wheaton's all around the world?
Yes, they operate all over. I think they're pretty much on every continent, if memory serves me well. So they have streaming that comes from mines literally all over the world.
Any concerns with some of the mines, where they are, locations, things like that?
Not so much from Wheaton's side. So I think that's really why we play it through Wheaton versus going to one of the actual mining companies themselves, because then you're taking sort of geopolitical risk, you're taking mining risk, even financial risk, frankly, on a lot of that. Versus playing with the streamers, you actually can get just really a sort of a leverage play on the actual metal itself.
Without having to go deep, without having to dig into it.
Absolutely.
And so that keeps it. What's it been like for them? What's some of their numbers, or some of the things that really caught your eye with the stream?
So really, again, we're more of a quantitative momentum-based advisor and portfolio manager. So right now, it's just quite literally been the price movement has been going in the right direction.
And that's enough.
And that's enough for us to participate in. We're in there right now. We may not be in there in the not too distant future. We kind of jump in and out, but Wheaton's been a name, and also another one, Franco-Nevada, that I've talked about recently as well. We've been in and out of them several times over the last few years.
And how long do you stay in for?
It depends.
It depends, but...
So if the momentum stays positive, we could be in there for quite a while. I mean, we've had positions in gold overall, I'd say on and off for majority of this year. So it's been in probably more of the year than not.
Okay, let's take a look at Walmart, going the opposite way.
Yes.
The classic bricks and mortar, but it's just rock solid, isn't it?
Absolutely. They've been a strong performer for quite a while. So if you're concerned about sort of, where the U.S. consumer is going, Walmart's actually a good way to play that. But if you look at, even just a few weeks ago, they had fantastic earnings. So coming off of the back of that, the recent CEO change as well was a little bit sort of choppy overall, but I think the market overall has seen this as a positive, and it's been a great performer for quite a while.
And what's some of the other things from it, the momentum that you're liking there?
So again, it's primarily price momentum, so that's kind of the major variable that we're looking at. But from a risk-adjusted return standpoint, it's been a pretty stable performer. So there's not a huge amount of volatility in the name, which is part of the reason why we like it relative to, let's say, a lot of other names out there.
And the price momentum, it's where's it going? Obviously it's going up. You're liking it, but
yes. So it's been going up pretty consistently actually for the last little while. So if you look at a chart for over the past year, it's been pretty much up towards the right, and that's kind of what we wanted to see. So overall, we've liked the name. There's been sort of periods of volatility in and out, but overall, we've been in there for majority of the year.
And is it at that price momentum the same when you decide to get out for that one too, or are there other factors when it comes to something like Walmart compared to metals?
So if there's a major sort of earnings miss, that will typically get priced into the actual securities price itself. So if you actually ask me if I have only one data point to actually really look at, I'm going to look at price, because it's the most all-encompassing data of anything out there. And the more recent the data, the more relevant it would be in the overall momentum. So it's a name that we like, and right now it's going in the right direction. People at this time always turning to Walmart price point, right? It's such a huge factor for them.
Absolutely. ABB, a Swiss industrial and technology company.
Yeah, so this is number one, a way for us to get some more international exposure in our opportunity strategy. But in addition to that, it's sort of a quasi-play on sort of the AI story as well. They're into the whole electrification of a lot of the data centers and whatnot out there as well. Also just kind of mainstream industrial automation. So it's a name that we like. We've participated in it. It's actually pretty decent weighting right now, a little over 10% in our model. So it's a name that we like. And again, we're seeing that positive momentum going into it. It's a bit of an offshoot off of the overall AI story. But again, I think only about 7% of the overall revenues are related to AI.
And with the AI, is this where you like to be? Is kind of on that edge there with companies like this?
Yeah. So if you take a step back and look at sort of the old gold rush analogy, right? Do you want to be in trying to get the gold, or do you want to in the mine, or do you want to be selling the picks and shovels, right? Yeah. So we like the picks and shovels, and if you look at this is sort of our way of playing that.
And ABB been around a long time.
Absolutely, and they're operating all over the world as well. So and they like to sort of source their energy local and sell it local as well. And again, with their whole electrification story, it's a name that we like.
And you see what are your thoughts on AI, the momentum with it?
So this is the billion or trillion dollar question, right?
I'm going to put you on the spot for a sec.
It's hard to say which way it's going to go. I don't think the story is over, but could we see some volatility? Absolutely. And I think that's what we're seeing right now. But if you look at where we are, even just 18 months ago, with any of the LLMs that are out there, it was basically not even close to where it is today. So I think there's still a lot more legs left in it, but I don't think it's going to be a straight up ride. I think we're in for some volatility.
But still, you'll stay on the parameters with it when it.
Yeah, so with that, the NVIDIAs of the world, some of the chip manufacturers, we like to play in the peripheries because, again, I think the obvious winners and losers are going to be very difficult to predict. So if you fast forward 10 years from now, what are going to be the obvious names that are going to be there? I couldn't tell you, but I can tell you that some of their chip providers and also sort of the peripheries will likely do well.
And what other sectors do you look at within that?
So again, there's the industrial automation is something that we do like as well. We also like the semiconductors are a place that we have been playing. So those are kind of our main ways of playing it over the last little bit. Okay.
And any others standing out with like some of the ABB that?
Not necessarily off the top of my head. Like recently, we bought in and out of NVIDIA, obviously, like most people recently, and we've also been playing sort of BABA a little bit over the last little while. So that's been an interesting name that we've liked as a way to get into sort of the Chinese market.
Okay, we're gonna have to wrap it there, but thank you, Shiraz, excuse me. Thank you very much for joining us today. Shiraz Ahmad, CEO of Sartorial Wealth. And coming up on Friday for the market call, we were joined by Ryan Bushell, President and Portfolio Manager at New Haven Asset Management. His focus, Canadian dividend stocks. His top picks were Brookfield Infrastructure, Aecon, and today NBCE, our parent company. Today on the show, we have Theo Lind, manager at Lind Equity Fund. His focus, North American stocks. When we come back, Canadian home prices dip as momentum stalls heading to year end. New data out from the Canadian Real Estate Association shows that Canadian home prices dipped in November as the momentum the market built through the middle of the year waned heading into the winter. For more on this, we're joined now by CTV's Colton Prale. Colton, thanks as always for joining us, sir. The numbers off quite a bit, eh?
Absolutely, they are down 2% as far as prices go. Home sales down really significantly, just about over 0.5% month to month, but 10, almost 11% year over year down in the sales. Listings have changed also quite significantly. And really what you're seeing here is something that anecdotally we have been reporting on for several months now. You've been seeing it in the market. There has been this tightening, right? Canadians are feeling it across the board, this financial uncertainty that exists going into 2026. Certainly all the consumer confidence surveys from Nanos have been showing the same sort of thing. And this is what the CRA is saying, CREA, I should say, is saying that this is essentially a holding pattern that they think is going to continue on into 2026. Now, there may be some changes next year, especially as the Bank of Canada has basically said, hey, the rate's not changing going forward. It's not getting any lower. They think that could incentivize a little bit of demand going into next year. You're also in this unique position right now in the market where it's not really a buyer's market. It's not really a seller's market either. The inventory is relatively close to where it is on average at this point in time. But while the inventory is about average, the total sum of listings is still down 2.5% compared to the average. It's up from last year. We're seeing a slower return to where things used to be, but it is still below average. And so you're really seeing that financial stasis almost that we see across the board in Canada really showing up in the housing data here as well.
And there's a lot of balls in there, isn't there? Because we're reducing immigration, so that demand is easing. But then the reality is people have to move at times as well. So 2026 could be an interesting year.
It absolutely will be. And, even looking a few years down the road, the big question is where are these people moving to? Because if you're looking at large centers, we're seeing slowdowns in housing starts. I mean, Toronto, Vancouver are down significantly. Toronto housing starts down 11%. Montreal is up 24%. And we're seeing that drive outside of Ontario and BC and in the prairie provinces and Atlantic provinces, trying to build up that glut of supply. But, I mean, this has been a conversation we've been having for quite a long time, especially those purpose-built rentals are really the only thing that are being built right now in major cities. And so when it comes to single detached homes, when it comes to multi-unit sales, all of those, a really significant concern on the supply side moving forward. And what you're seeing right now in the immediacy, according to the CREA, is sellers deciding to take the hit on price just to get the sale across the line because there is such a struggle to get things done in a timely manner.
Okay. Colton, we're going to have to leave it there. Thanks as always, sir.
Anytime.
CTV's Colton Prale. Debbie Sue, the CEO of OpenTable, says consumers will continue to prioritize dining out and the overall restaurant experience. OpenTable is an online restaurant reservation service. She spoke with Bloomberg's Romaine Bostick and Katie Greifield about the dining trends expected in 2026. Have a listen.
I do think people want to go out. We've seen that year over year since the pandemic. People continue to prioritize the experience of dining out in their household P&L. I think that's one piece of it. People are craving connection. They want to be taken care of. And I think they want to support their local restaurants. I think all of that is wonderful. I also do think there's a part of it where, I don't, Romaine knows this. I'm not a great cook. I don't do it often. I did try during Thanksgiving. So, we went to the grocery store, we bought all the things. I was astounded by how much things cost. Mm-hmm. And so restaurateurs are so scrappy and innovative and resilient. And oftentimes we've seen, even with labor shortages, supply chain interruptions, inflation, they have not pushed that full cost that they're seeing onto their diners. Right. So oftentimes going out to eat could be a better deal. So I think it's both of those things.
Yeah, it's interesting. And you've seen that really across industries, not just in restaurants. Basically, companies taking on and eating some of the cost of those higher prices. But I want to talk a little bit about generational differences here, because I'm taking a look at the consumer segmentation breakout, and millennials actually plan to dine out 14 times a month. That is the highest of any generation. Is that usually the case, Debbie?
We haven't seen it be this high in one particular demographic, and it's funny because when I saw that stat, I was like, do I count in that? So I had to Google that and check. Yes, I indeed am a millennial. 14 times is very high, but if you think about maybe on the weekends, brunch, lunches, once or two during the week, and then a few dinners. If you break it down that way, it's not that surprising, and it's not actually that much if you think about, in your own life. But, I guess in some ways it does make sense, right? Millennials often have jobs, right, are of a certain age, have the resources to go out and dine out more frequently than perhaps those who are just starting, for example, in their career.
Well, I am curious also in this, you've been speaking of millennials. We'll just dig on millennials for a little while longer. 79% of them, according to your data, say the restaurant's, quote, Instagram TikTok worthiness matters in where they choose to dine. I'm not actually too surprised. I have a couple friends who are restaurateurs, and this is something they talk a lot about, is how much attention they have to put now into the decor and other non-food elements just to get people in the door. I assume that's been a trend that's been unfolding for some time.
It has been unfolding for some time, and I think if you talk to any restaurateur now, not even the ones who kind of grew up in the age of social media, they know that it's an important part of how diners are discovering them. So whether that be on TikTok or Instagram, but what diners want to know is it's not just, how your food looks in a photo. And it's not just about the ambiance of the restaurant, although all of those things, of course, are very important and contributing to a diner experience. But they want to know the story behind the food. Like, why did you pick this cuisine? Why this neighborhood? Why this size of restaurant? I think that's what's really resonating. People want to hear the storytelling from the restaurants. And myself, right, because I didn't grow up with social media, it's been even astounding to see for Open Table how much people engage with our brand on these channels.
Well, I am curious about that, particularly with regards to your business, to Open Table's business. You've got tens of thousands of restaurants on your platform right now. I am curious, but we've seen some increased competition from places like Resi and Seven Rooms and a couple others that have cropped up here. How do you make sure you keep people engaged? I mean, obviously you have to get the restaurants on the platform, but how do you keep the average consumer engaged, not just to come to your site to book, but to actually do a little bit more?
There's a lot of things that we do, but first and foremost, what we do is we are a platform for our restaurant partners. We promote and tell their stories. I always tell the company, it is not our job to be cool. Our restaurants are cool. Let us be a tool in which that they can tell their stories.
And that was Debbie Sue, CEO of Open Table. Coming up, we'll tell you about the growing challenges protecting Canadian data from U.S. authorities. Well, Microsoft and Canada face challenges protecting data from U.S. requests for more. To explain this a little more, here's CTV's Jeremy Sherrill.
Physical borders. They are a clear visual indication of Canada's sovereignty, but in a digital world, they don't have the same power.
You've got this sort of meshing of borders where you've got multiple countries saying their laws ought to apply.
While Microsoft will expand data centers in Canada over the next 2 years, amid trade and geopolitical tensions under U.S. President Donald Trump, Canadian companies are looking to rely less on American tech companies to store their data over concerns about the U.S. government's ability to access it.
We have said that, if the U.S. government seeks data from a Canadian customer, we will stand up to defend that. If there's a legal basis, and there typically is, we'll go to court.
But under U.S. legislation known as the Cloud Act, American companies could be compelled to hand over Canadian data to U.S. officials if compelled by a warrant. Microsoft's president was asked about the viability of his pledge to protect Canadian data.
We rely on our own relationships on Capitol Hill and with the administration itself. I have a lot of confidence in our ability to succeed.
But protecting digital data or defending digital borders isn't easy, says this professor who specializes in internet law.
The problem is if you get a U.S. court saying, well, not so fast, we want U.S. law to apply here, there's a pretty strong likelihood that faced with that potential conflict of laws, Microsoft may feel that it's got no choice but to comply with U.S. law in those circumstances.
Other jurisdictions are facing the same challenges with digital sovereignty. This summer, Microsoft France testified before a French Senate inquiry that it can't protect EU data from U.S. authorities.
Jeremy Sharon, CTV News, Ottawa.
Coming up, the maker of the Roomba vacuum declared bankruptcy this weekend. We'll get more after this. Welcome to the second hour of The Open. I'm Roger Peterson. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. Canada's annual inflation rate held steady last month. Data from StatsCan showing the consumer price index rose 2.2% from the year before, matching the rate in October. StatsCan says lower prices for travel tours and accommodation, as well as slower growth in rent, put downward pressure on headline inflation. Meanwhile, grocery price inflation rose to its highest since the end of 2023. Home sales across the country saw a decline last month, along with home prices. Data from the Canadian Real Estate Association indicates national sales fell 10.7% in November compared to the year before. Home prices, meanwhile, fell 0.4% month over month. The association says housing activity has turned into a holding pattern heading into the new year, adding that continued trade tensions with the U.S. have weighed on buyers' confidence. New listings also saw a decline in November. Shares of Canopy Growth are seeing some pressure. The Canadian cannabis company has announced it will acquire Quebec-based MTL Cannabis for $125 million. That represents a premium of about 45% on MTL's 20-day average price. Canopy says the deal will strengthen its medical cannabis business as well as increase its presence in Quebec and boost capacity to serve growing international demand. And taking a look at the markets, and you can see the TSX it's down, still up, but had a hot start, and then it slowed a little bit. It's at a wash right now. Heading south of the border, same situation. They were all up when the market's open now. They're at about a wash with the NASDAQ up slightly at 0.1615% right now. And looking at oil, it continues to struggle. That pressure, it's down below 57 now, WTI, and off for the year 20%. Gold is a safe haven. People are still loving it. Look at that. It's at over 4,300 near record territory, 43.44 right now. And silver and copper, similar situation. Silver's also on record highs right now. They are doing well. Let's head over to the loonie, see what it's doing. And the loonie is up slightly against the U.S. dollar. Metals driving that one up, of course. The company that makes Roombas declared bankruptcy this weekend. iRobot has been struggling financially for years as their vacuums have been facing tough competition from foreign autonomous vacuums. Our next guest says this goes to show that not all technology pioneers will be successful because it's difficult to stop copycats. Let's get more on this now from David Dietz, Chief Investment Strategist at Dietz Wealth Management. David, thanks as always for joining us.
Good morning, Roger.
A very expensive lesson, I guess, or a good lesson if you're looking at inventing something and becoming famous. Make sure you do it right.
Well, absolutely. I mean, this company started out to great fanfare back in 2002 with its, pioneer autonomous robotic vacuum cleaner. And of course, the iRobot brand name there is Roomba really became synonymous with this innovative technology. And at one point, this company had a market cap very close to $4 billion.
Wow.
And even now still has the major market share in this country for that. But a series of missteps going back to when activists from private equity forced them to divest a defense division, which would have given them another area to diversify in. That shrunk their company a little bit. And then, of course, the demand post-COVID, when people were no longer staying 100% at home, plummeted. And, of course, all sorts of key competitors from China are coming in with better technology. They're using LiDAR, and they're coming in with cheaper prices, and that's really eroded the share and profitability for this poor company.
So it's difficult to you have to diversify. What's the most important of all those things that you said that were brought to its downfall, or do they all matter? Are they all almost equally important?
So their downfall has been going on for a while. When they realized that they were going in the wrong direction, Amazon made a run at them, and they were going to pay about $1.4 billion for the company. But, investors always love merger and acquisition activity, but you got to look at what the regulators are saying. And both regulators on this side of the pond and on the other side of the pond had big thumbs down. And so Amazon backed away. They paid a $90 million fee to be able to walk away because they weren't going to get the regulatory approval. Then they incurred more debt, and things just continued to go downhill. What's interesting, though, Roger, is just as recently as 10 days ago, this stock rose 73% on news that President Trump was going to make a big robotic push in this country. And people without any regard to the amount of debt on the balance sheet or how that they were losing shares drove the company up saying, hey, the company has the name robot in it. Trump is behind the theme. Let's buy in. But of course, that is all for naught now.
All right. On that note, let's move on to a Christmas Santa Claus rally. Do you think it's in the cards this year?
I do. We were all watching the key event, which is going to be tomorrow, which is going to be the November jobs report. We've all been starved, including the Federal Reserve, for actual real-time data on how that all-important labor market is doing here. If it's actually 4.5% or more, I think the market actually might rally even further because it's going to open up the possibility for even more Fed rate cuts next year. If, on the other hand, it's perversely looks better than people are forecasting in the 4.4 or 4.5 area, then the market may well sell off here because the prospects for more monetary support next year will be diminished.
Interesting. And is there any factor that we had a kind of abnormal September, October, where traditionally we'd see the dip? We didn't really see it this year. Will that play in at all with this?
Exactly. Although there may have been a payback for most of November, the market didn't do well. And indeed, the Magnificent Seven and the NASDAQ actually lost in November, which is typically a good month. But of course, investors do have to keep in mind that the Santa Claus rally is technically the last 5 trading days of this month and the first 2 of the new year. 79% of the time since 1950 has been a positive experience for the market, and the average return is 1.3%. But as you point out, in September, October, the market did very well, even though those tend to be not the best months. So you really want to, investigate in your fundamentals at all times and not just look at the historical lore.
And as we head into the new year, you're looking at small as big, small caps.
I think what we're seeing, it may have already started, kind of a bit of a rotation out of the AI trade. I think for a number of reasons. One, of course, valuations are very, very high, but they're also seeing more competition as, OpenAI thought they had the magic bullet for AI. But of course, we've seen with Gemini from Google, the competition is very, very fierce. And with interest rates still low and likely to stay low, I think investors, instead of leaving the market, will rotate, and certainly valuations in the small cap area look very, very attractive. And if this economy stays on track, that's really going to be good news for domestically based companies and smaller ones.
And what might make some people hesitate, just before we go, moving to small caps?
Recession risk. If the unemployment rate goes up a little bit, and that causes the Fed to be more generous, that's good. But if it starts to go up a lot, given that consumers are 70% of the economy here, if the job market starts to get really shaky, they're going to pull back on spending. And smaller companies with less resources, with a tendency to have more debt, and lots of them somewhat cyclical, could be hit hardest.
Okay, we're going to have to leave it there, but David, thank you as always for joining us.
Thank you, Roger.
David Dietz is Chief Investment Strategist at Dietz Wealth Management. Coming up, RBC economist Claire Pham will give us her take on today's inflation data right after the break. Stats Canada just released the numbers for the Consumer Price Index for November. Inflation holding steady at 2.2%. CPI rising 0.1%, matching estimates. Here to discuss those numbers and what it means, Claire Pham, Senior Economist for RBC. Claire, thanks as always for joining us.
Thank you for having me.
Overall picture, the numbers, kind of what everybody was expecting, slightly lower, right?
Yeah, so the headline at 2.2 is actually exactly what we're expecting, but I think the details weren't quite as expected. For example, we've seen actually pretty big improvements in the Bank of Canada's core measures. So these are CPI trim and median that tend to not capture some of the other more volatile component. But the bad news is we also saw a pretty big increase in food inflation to the highest point since the end of 2023.
Okay, let's talk a little bit first about the trim and median. I was just reading, I thought they were going a little bit away from that, as not putting as much, having as much influence, the trim and median, but it's still, you still think it matters?
Yeah, for sure. I think it matters in an extent as to what it measures, which is the components of the consumer basket that the Bank of Canada can influence with monetary policy changes. And of course, these include mostly services components that's really both driven by demand. We're mostly demand side of the economy, which again, sort of interest rates can have a lot of sort of influence on. Versus if you were to look at food inflation, it's mostly, the surge that we've seen in November, for example, is driven by global, sometimes supply disruptions, which is, again, not something that the Bank of Canada can sway.
Yeah. Is that tariffs then having the impact? Is that what we're feeling with that?
Yeah, so tariff is a small part of the story. That's kind of how I would see it. So from the food inflation perspective, most of it is really, again, just, within Canada, drought conditions in parts of Western Canada, they're really thin. The cattle herd that drove up beef prices or beef inflation to over 17%.
Wow.
Outside of that, coffee prices as well. Yeah, coffee prices, you're going to like this number, is even higher, way over 25% on a year-over-year basis. Right, me either, actually. So a lot of sort of the coffee story is playing out globally. So we do see, for example, production and exports from countries like Brazil and Vietnam, which combined accounted for over half of global coffee production. Production is really soft, again, because of really hot and dry weather over the past couple of years. But tariff certainly is a part of the story as well. And this is something that we've been highlighting, which is that, even though there are not a lot of direct counter tariffs measures here in Canada, we can still see impact just because U.S. importers who are importing globally from other places are paying those tariff costs. And when they do re-export these products, for example, refined coffee products into Canada, prices will be inflated.
And with some of those grocery prices that you're talking about, beef, the droughts, any indicators how things are looking as we head into 2026? I'm kind of making you pull out a crystal ball on this one.
Yeah, so obviously supply disruptions, they're not just something that's been limited to this year. Like I said, it's been happening over the past couple of years, and sort of it takes a while essentially for cattle herds to start sort of growing again, for that inventory to start to build, for price growth to normalize. So unfortunately, at least in the near term, food inflation will likely still be a little bit more uncomfortable than we like to see.
And what were some of the stronger things that we saw for dropping that people will hopefully be feeling and enjoying a little more?
Right. So another essential item, which is shelter, right? So shelter inflation has come down a little bit. And if you were to look at the two key components when we think about shelter, one is rented accommodation. So rents started to grow a little bit slower, even though it's still pretty high at 4.7% year over year. And then the other component is homeowners, owned home accommodations. So a big one in that one is mortgage interest costs, and that component is continuing to moderate as well. And that's just because of the past Bank of Canada rate cuts that we've seen, 275 basis points, that will continue to flow through to support housing activity as well as driving sort of that mortgage interest component down.
And then big picture across the country, some areas hit harder than others for different things?
Yeah, exactly. So moving over to sort of the inflation outlook to 2026, or as far as Bank of Canada outlook goes, really, I think what the bank was expecting in the past, which was this kind of upside inflation pressure from trade reconfiguration to quote from the Bank of Canada, versus downside from just growing excess slack in the economy will continue to moderately offset each other. That's exactly what happened in November. And if this sort of trend were to persist into 2026, this is kind of the outlook for inflation that we and the Bank of Canada are holding. And this is why we don't expect there to be rate cuts or rate hikes really until 2027.
Yeah, there had been some talk of possibly a rate hike towards the end of the year, but you think that's being pushed back?
For sure. So I think risk to that kind of an outlook, which is headline inflation tracking around 2%, and the Bank of Canada is going to hold steady through the 2026, is to the upside. And mostly that's regarding inflation. So if we were to look at domestic demand, consumer spending has actually been incredibly strong this year, despite all the headwinds, including tariff uncertainty, including sharply slower population growth. Aggregate consumer demand is actually strong, and there's really not a lot of reason to expect that it will slow in 2026, and that's one of the key upsides to inflation that we see. And the other component, of course, is just the trade configuration costs. Already we're starting to see signs that it may be a bit more expensive or pricier than we were expecting. So given those risks, we do think that, if we have to say where the risks of balance are tilting, it will be tilted towards more inflation, not less, and sooner Bank of Canada rate hikes in 2026.
Okay. Claire, thanks as always for joining us.
Thank you, Roger.
Claire Fan is a senior economist for RBC. Coming up, we'll take a look at some of the opportunities in emerging markets for the year ahead. That's after the break. Well, Pictet Asset Management released its 2026 investment landscape, saying the outlook for global equities will start improving. Our next guest says he expects the macro backdrop to switch from mild stagflation to a Goldilocks environment over the next year. Let's get more from Arun Sai, senior multi-asset strategist at Pictet Asset Management. Arun, thank you very much for joining us.
Thanks for having me.
All right. What makes you think Goldilocks is coming next year?
Right. So I think we have to keep in mind we are going to go through a phase where macro data is going to be quite hard to pass, but we are looking ahead of that. And we have to keep in mind that policy is going to be supportive for much of next year, both on the fiscal and on the monetary side. We continue to expect the impact of rates relief to feed through into the real economy. So all of this will, in our view, contribute to, if anything, an upside surprise on growth. And that leads us to be quite constructive, overweight equities. But we have to keep in mind we're not going to shoot the lights out. This is not going to be a year when returns are going to be high. We have mid to high single-digit returns for global equities in mind. And within that, we have to be very selective because equity investors in particular have a double whammy facing them: very high valuations and extremely high levels of concentration in markets today.
And where are you looking when it comes to that? Which area, do you have areas that you're liking, areas of concern?
Right. No, absolutely. When we have low returns and high volatility as the environment, we have to be very selective where we take risks. And we like, for instance, value and value-oriented strategies in Europe, in Japan, where we see a modest cyclical recovery play out, and also fiscal support for most of the year. On the other hand, though, in US, we like growth. We still want to be selectively exposed to the AI CapEx cycle for now. But through the year, we expect that to broaden out into other areas.
Okay, let's talk a little bit more about Europe. What are you favoring there?
Right. So the structural and cyclical issues, headwinds facing Europe is very well flagged, and we think that's well priced into valuations today. So we need to keep in mind, though, that expectations on the Germans, for instance, following through with fiscal spending, especially on infrastructure and defense, is very low. So that sets up a very low hurdle for an upside surprise. So if we do see traction on that front, we think there would be outsized returns in European equities, especially in European and German mid-cap. That said, we are framing this as a cheap optionality within a diverse portfolio. It's not our base case call. Our base case is that European equities would still struggle to match US and EM returns, but it offers us a cheap optionality for upside.
And the other one in Europe you're looking at is healthcare.
No, absolutely. Healthcare for us is a great opportunity because this is a sector which has had a series of headwinds the last 2 or 3 years. It's underperformed for 3 straight years. The valuation case is very clear. But as always, we have to look for catalysts to unlock that value, and we think those are falling into place. We think we are now past peak policy uncertainty, both on the tariff and on drug pricing. And we have a very constructive outlook for M&A in the sector. So healthcare for us isn't just a preferred defensive play, but we think it gives us a very interesting opportunity to get in on an innovation cycle in quite an early innings of that playing out.
And in Japan, where are you looking in Japan?
We like value. We think we are in for a cyclical recovery. We see a bit of curve steepening as well. That should help the banks. We still see some of the value up kind of programs, corporate governance improving, and all of that play out. That has legs as well. So all of that tells us that value over growth should be a good trade in Japan for at least a year ahead.
Okay, and you're also looking at emerging markets. What's so appealing to you about them?
Yeah, no, see, the promise of EM isn't new. Right? So when it comes to EM, we should always ask ourselves, why EM now? And on that, we think the macro backdrop is quite enticing. If you think of a lower dollar, if you think of rates continuing to come down, a modest global manufacturing recovery, higher commodity prices, typically when you have these drivers in play, we find that EM outperforms about 80% of the time. So that's a very strong macro tailwind. But it's not just that. At a domestic idiosyncratic level, we are seeing strong drivers, and we are seeing opportunities across the investment spectrum. So we don't want to be boxed into certain investment styles. On one end, we like India, where we think there's a very clear growth positive policy pivot that should, if anything, give us a growth surprise next year. Valuations are not unreasonable. And other end of the spectrum, we like Latin America. We think there's significant scope for real rates to come down, and you see a bit of a multiple expansion and a cyclical recovery on the back of that. So there are opportunities across the board, and not just in equities, in EM, local currency, hard currency bonds as well. So we think it's quite an interesting time to pick up opportunities in EM.
All right, Arun, we're going to have to wrap it up there, but thank you very much for joining us.
Thank you.
Arun Sai is Senior Multi-Asset Strategist at Pictet Asset Management. When we come back, we'll hear some of the reasons why well-known economist David Rosenberg has turned bullish on the Canadian dollar. He's got a target of 77 cents US. That's just ahead. Canada's inflation rate held steady last month. Data from StatsCan shows the consumer price index rose 2.2% from a year earlier, matching the rate in October. StatsCan says lower prices for travel, tours, and accommodation, as well as slower growth in rent prices, put downward pressure on headline inflation. Meanwhile, grocery price inflation rose to its highest since the end of 2023. Home sales across the country saw a decline last month, along with home prices. Data from the Canadian Real Estate Association indicates national sales fell 10.7% in November compared to the year before. Home prices, meanwhile, fell 0.4% month over month. The association says housing activity is now in a holding pattern, with continued trade tensions with the U.S. weighing on buyers' confidence. Shares of Roomba, the maker of shares of the Roomba maker, iRobot is the company. Well, they're plunging. And after the company filed for bankruptcy and proposed handing over control to its main Chinese supplier. Its common stock will be wiped out under the proposed plan, which will allow it to remain as a going concern. iRobot has sold more than 40 million of these robotic vacuums, but has been grappling with an earnings decline following COVID. The slowdown is due to supply chain issues and cheaper competitors. Taking a look at the markets, it's been an up and down day so far. You can see the TSX launched nicely this morning. Now it's barely up. It's pretty much a wash. And south of the border, you got the S&P 500 up by about a fifth of a point, excuse me. And the NASDAQ composite, it's up by, they're both down. I was being optimistic for a second. S&P 500 is down by 0.16%. The NASDAQ also down by a half a point. Canada's been seeing economic growth, including in more employment and with the dollar on the rise. Our next guest has just turned bullish on the dollar for a number of reasons. Here to unpack them is David Rosenberg, founder and president of Rosenberg Research and Associates. And David, thank you very much for joining us.
Thanks for inviting me on.
What makes you so bullish about the dollar right now, the Canadian dollar?
Well, look, I'm not a raging bull, but I've been becoming in the past several months increasingly less bearish. We were negative on the Canadian dollar, and for the most part, quite right for the last couple of years. But as John Maynard Keynes said, when the facts begin to change, you should start to change your view. And so there's been some changes at the margin in the past several months that we've taken notice of. One of them being that the Bank of Canada seems very comfortable staying with the policy rate where it is at 2.25%. The Fed just cut. They're probably going to cut some more. I think at least one more rate cut. I think in the U.S., the dot plots, I don't really pay much attention to them. I think the Fed's got at least 2 or 3 more cuts and the bank's on hold. So the interest rate differentials are going to increasingly be a tailwind as opposed to what was a headwind for the Canadian dollar through much of the Bank of Canada's easing cycle, which of course took place before the Fed started getting into the game. So that's one part of it. The other part of it is that our terms of trade, our export prices relative to import prices, which has a strong correlation with the loonie, has started to really improve. We got to keep in mind that unlike the United States, Canada, much like New Zealand and Australia, we are a hard asset currency, and the commodity sector is starting to look a lot better, especially in the base metals, and oil prices look to be putting in a floor. So that's added good news. There's certainly less negative news for the Canadian dollar. Then it'll come down to the fact that, we dodged a bullet because, you go back to the spring, we thought that Trump was going to unleash a major trade war against Canada with all those reciprocal tariffs, that we're going to enter into a global trade war, which would have additional negative consequences for Canadian economy because we're a small, open economy. So we dodged those bullets. And the reality when push comes to shove, and this is what's different with Carney vis-a-vis Trudeau, is that whether you like it or not, I certainly don't mind it, is that Donald Trump has chosen to like Mark Carney. What that means for renegotiating the trade agreement next year remains to be seen. But the reality is this, that for all the angst and anxiety over the tariff file, when you look on a relative basis to the rest of the world, we came out relatively unscathed. Most of the products that Trump slapped tariffs on most of them are covered by the trade agreement and weren't affected by the tariff war. So, of course, we're still all upset about the 51st state and, a lot of the stuff that Trump has said in the past. But the reality is that when you look around the world, we came out actually a relative winner from the Trump tariff file. So all these things put together, and of course, we look at valuation metrics. We look at valuation in the stock market, and in the U.S., it's nosebleed levels. But for the Canadian dollar, the valuation metrics that we looked at in the past couple of months were telling us that the Canadian dollar was extremely undervalued. The question is, what was going to be the spark? And I'll tell you that it's not just the Fed still cutting rates and the Bank of Canada on hold, but I gave the Carney budget a B minus, which sounds like I'm a tough grader, but I haven't given a mark like that for a Canadian federal budget since the Harper years.
Wow.
So there was lots in there because it really was at its root. I mean, look, every budget's going to have its warts, its pimples, and its scars. But I did like the supply side productivity nature to this particular budget. And the fact that now we're starting to see Mark Carney, I'm sure the environmentalists are all up in arms about it, but I'm here forecasting the Canadian dollar. The fact that Carney at the margin has shifted away from his, green thumb pro-environment policies towards something that's more pro-growth, especially on the resource side. To me, if you're a Canadian dollar watcher, that's another big positive. The fact that we have a more responsible immigration policy now means that, and as you said about the economy, we're finally starting to see for the first time in many, many years, positive growth in real per capita terms in Canada. So absolute terms, growth might not be that great, but per capita, it's been negative because of our unprecedented immigration policy. So that, again, at the margin, all this stuff helps. 77-cent dollars, like, I'm not saying we're going back to par. Wouldn't it be nice if we ever did? But I think that enough of the negatives, enough of the headwinds have been taken out to at least shift from what was the long-term bearish stance on the loonie to something that's a little more moderately positive.
And what might be some of the challenges with a 77-cent loonie? Those are, you mentioned the positives or what will guide it and what will bring it up to there. What might be some of the challenges as the dollar rises, though?
I don't think that there's, so long as the Canadian dollar doesn't go above its fundamental valuation metrics, there's nothing wrong with it. It's not like, the Canadian dollar is going up and this is going to be a major impediment to the manufacturing sector. It's basically just, the Canadian dollar is a price. Like everything else is a price. It's a price. And the price is revealing some of the improving fundamentals in the Canadian economy. So it's not like you're going to say, the Canadian dollar is appreciating, we should all be worried about it. We should actually embrace it. Because when you really think about what is a currency, what's an exchange rate, it's a relative pair trade. So here we're taking a look at Canada versus the US. We could look at Canada versus other countries. But when your currency is appreciating relative to your neighbor, it means that relative to your neighbor, things are going right on a relative basis. So I think it's something that we should be embracing because it's a price that's reflecting at least something that isn't as negative as it was 6, 12, 24, 36 months ago.
And what does that do for servicing debt?
What does it do for servicing debt?
The stronger.
Okay, well, that's a real circuitous argument that it doesn't do anything for servicing the debt, except insofar as if I had to basically, draw an argument, really second round impact. It's basically a stronger dollar will help contain import costs. It is ipso facto something that would be inherently disinflationary. So it would mean the potential that interest rates can come down at the margin. But that's drawing a really indirect link. But if you're talking about how to service the debts, because a stronger currency leads to lower inflation as a standalone event, it should be good news from that perspective, at least at the margin.
Okay, David, we're going to have to leave it there, but thank you very much for joining us.
Pleasure. Take care.
David Rosenberg is founder and president of Rosenberg Research and Associates. Coming up, Hot Picks will zero in on 3 plays in biotech when we come back. From rate cuts to Canadian inflation data, Canada's economy has seen many ups and downs this year, but one aspect always worth addressing is how Canada's Indigenous community is dealing with the economic changes. Let's reflect more on this year and get an outlook on next year's expectations with Tracy Smith. She's the founder and CEO of Kiwewin. And Tracy, thanks as always for joining us.
Good morning.
We just saw the inflation numbers out today. What kind of an impact does inflation have on communities, Indigenous communities?
I think the biggest impact for inflation is, especially when communities are looking to build or acquire or purchase any sort of asset to build up their economies and their communities, right? Like anything to do with housing, infrastructure, any sort of businesses that they're getting involved in, they really do look at the price of purchasing these items now versus waiting a year or two out to purchase these kinds of and make these kinds of investment decisions. So inflation is a very top of mind when you talk to a lot of communities is, do they make that decision and investment now, or do they wait another year or two out and potentially take some risk with that? So these numbers are very important to the community in terms of these kinds of economic decisions. And
I imagine the inflation is felt harder because a lot of the time these things are more expensive to get to some of the more remote communities.
Absolutely. Usually, by the time you start purchasing these kinds of items, they might have touched 3 or 4 manufacturers, right? So in terms of, say, for example, they're building a home, they're purchasing from a modular supplier who had to purchase those materials, who then had a delivery truck deliver it to the community, who also is affected by these prices. So it definitely does, they have to look at the whole chain of command in terms of these kinds of decisions.
And what other big concerns were there for the economy this year when it comes to the Indigenous community?
I think the biggest thing that the community is really looking at right now is these major projects and how they're involved or how they're not involved. This government is making a lot of announcements with or without the community involved. So a lot of the community is really having these meetings, chief and council meetings on how they're going to be involved and how they want to be involved, and really kind of making their seat at the table with this government. So we're really looking at, the next year out, how is this going to impact, not just the broader Indigenous community, but when you're from an individual community, how can you, in a way, muscle in on some of these projects and make it beneficial for your own community in these types of times, right?
And I imagine it's challenging because sometimes we hear different messages from different Indigenous communities or different leaders who are saying we want this, but others will say no, we don't, and trying to wade through and find a path for everybody.
Yeah, you know what? You can live in one First Nation where they'll say, yes, we want a pipeline or we want to access these critical minerals and benefit from them, where your next door neighbor might say absolutely not. So those kinds of conversations have to happen at the community level, and the government has to wait for those kinds of conversations to happen to see if there's a successful negotiation that can be had to get everyone on board or not. So those types of conversations happen all the time, every day, whether we know it or not. They are always happening.
And they are. And do you feel there's progress and balance and solutions that are working for everybody being found?
I would say in some instances, yes, and in some instances, no. It really depends on what the project is. I see a lot of divide in terms of moving forward with these major projects and not moving forward with them. And both sides have great reason to say yes or no. So it really comes down to the region, the geography of this country. Some First Nations are, sometimes the media will say, oh yeah, the First Nations are on side, but, and behind the scenes, we know that majority of First Nations might be totally against the project. So it really comes down to understanding at the community level where people sit with these kinds of decisions.
Is that a challenge then to try and find investment with those conversations happening?
100%. It's really important for any sort of partnering organization to make relationships with these communities, to really get to know what are their issues and to see if there's a way to rectify it to get to a yes. If the community is really against a project, there's nothing that even money can't do to solve those kinds of issues. It really comes down to the community. Do we want to prioritize the economics of a project and benefit financially? But at the same time, ruin our land, our culture, our waters in a way that it's irreplaceable, right? You can't change it once you dig that shovel in the ground and start pulling things out. So that really comes down to the community and what the community wants at the end of the day.
And do you find investors are approaching Indigenous communities now as an equal?
Oh, If they're not, they should. And if not, it's I think companies are further behind, just like we're seeing in terms of government relations, right? Sometimes government relations these days they're plowing ahead, and you know what? They're actually making the job harder on themselves by doing that, because they're just going to have to go back to those tables and negotiate. There's a thing called treaties, and legally, all of these companies and government, First Nations do have the upper hand in most of these negotiations.
And they're challenging negotiations, but are you seeing interest, or are companies getting involved?
Yeah, I think if these companies make the investment, if they know that this is not just a short-term, one-time project, and they really want to work with communities for the long haul, you're getting companies in there having a lot of success with these First Nations. If you have companies that say, we just kind of want to go in and out, economically benefit ourselves, help our share price out, those companies are not around in the next 2 years. But the companies that have made that investment, it's part of their own corporate strategy, those companies do extremely well.
Okay, Tracy, we're going to have to wrap it up there, but thank you very much for joining us.
Thanks so much for having me.
Tracy Smith is founder and CEO of Kiwewin. Coming up, Hot Picks. We'll zero in on 3 plays in biotech. That's when we come back. Time now for Hot Picks, and our next guest covers the healthcare and biotechnology sector. Here to give us her Hot Picks is Ritu Baral, Managing Director covering healthcare and biotechnology at TD Cowen. Ritu, thank you very much for joining us.
Good to see you.
All right, first up, we're talking about Insmed.
Yeah, so one of the things that we look for when picking a major stock for the coming year are 3 portions of the investment thesis: a base business, a product cycle, and pipeline. And we see Insmed, one of the newest large caps in the biotech sector, as having all 3. A base business of a rare pulmonology inhaled product that is doing over $500 million in sales. A product cycle with a new approval addressing a $1 billion market with literally no other approved therapies on the market. This is a new drug called Brinsupri for bronchiectasis, a not small 500,000 North American population, and then a deep pipeline, a de-risked pipeline of similar drugs that will expand the TAM for both Brinsupri and its follow-on indications that we think will expand valuation and investment drivers even further into 2026, 2027. And all of these compounds have excellent IP that give tremendous duration of asset that drive further value.
And how close, when you're looking at these, when do you decide to make this decision on, say, a company like this? How close are they close to bringing this to market now, or is it on the market?
It is just approved. It is on the market, Brinsupri. However, it is just starting its launch. It was approved late this year, and the first full meaningful quarter of sales will be Q4 sales, as announced likely in the first couple of weeks, pre-announced in the first couple of weeks of January. And then that valuation and that driver will be off to the races over the course of 2026.
And you mentioned they have 2 coming on. Is that unusual, or is this an unusual situation, or is that fairly normal? You see 1, 2, or 3, or is it just usually 1 at a time that come out?
Usually 1 at a time. In this case, Brinsupri is their current product cycle. They do have a base business called Arikayce that is a few years old. It is still growing because the 2 products share the same sales force, and therefore you have growth from 2 of these these portfolio products, because they're driven by synergistic sales and marketing.
All right, let's move on. Praxis Precision Medicines. That sounds like something that is really has a lot of potential there, right? It's essentially personalized. Is that personalized medicine?
It is a neuroscience-focused company that does have certain aspects of its pipeline that are much more personalized. They are going after both a broader indication called essential tremor. You can see where that phase 3 trial worked right on that stock chart. And they have a rare epilepsy pipeline. Now, this is one where it's unusual. They will be entering 2 product cycles about the same time, the rare epilepsy as well as essential tremor, with 2 separate compounds that ended up converging on the same sort of approval cycle and the same sales cycle. This is going to be a rapid growth story through the end of 2026. We are anticipating approvals over the course of 2026 to drive late 2026, early 2027 launches for both franchises, essentially. So you're looking at a stock that is entering this product cycle, as well as has a rich de-risked pipeline. 2 out of the 3 that we are looking for hot picks.
And what are those exactly, the illnesses themselves? You said rare epilepsy and what was the first one again?
Essential tremor.
Essential tremors.
So the major investor focus is a drug we call Ulixa. It's a shortening for essential tremor, which is a not rare condition of essentially benign but severely affects quality of life. Basically, an underlying tremor of your periphery, specifically your hands. It prevents people from working, typing, and in more severe cases in older patients, even taking care of themselves, being able to feed themselves, being able to hold a fork, brush their hair. And this has proven in phase 3 development to significantly improve the tremor as objectively measured, as well as subjective improvement in patient function by their own and clinician assessments. We think that this is a $5+ billion market. Those are both sell-side consensus estimates as well as our estimates of buy-side expectations. So a tremendous product cycle coming on for essential tremor for this Ulixa compound, which will be filed, we think, in the first half of 2026, likely driving a late 2026 approval and therefore 2027 sales numbers.
Okay, we're almost out of time. We got about 45 seconds. Palvella Therapeutics, what do you like about it?
Great data this morning from a pipeline program, but the lead program is going to have binary data in Q1. Now, this is your classic small cap biotech binary story. However, we see this Q1 data for a condition called MLM with their drug Qtorin rapamycin as being significantly de-risked. We know how rapamycin works. This is a drug with tremendous positive phase 2 data, and that phase 3 trial that we'll read out has great similarities to this positive precedent data, and therefore significant upside on that binary readout. Not for everybody, but it's a classic biotech setup.
Okay, I think we're going to have to wrap it up there, but Ritu, thank you very much for joining us.
Thanks for having me.
That was Ritu Baral, Managing Director covering healthcare and biotechnology at TD Cowen. Well, that wraps up this edition of The Open. I'm Roger Peterson. Lindsay's up next with Morning Markets. Have a great day.